Well, welcome to Kyle Green. Kyle and I have talked several times before about the mortgage market, and nothing is more interesting this September than what is the future on the mortgage market. Now, we have so many opinions as to interest rates. Some say there's going to be a full percent by year end, and then some of our major banks forecasting 3% by next year. And, and so the whole world is confused. Well, I think none better to lift that confusion than you, Kyle. I mean, Kyle is in the top 1% of mortgage brokers for 10 years plus. And that's in Canada, right? So if anybody knows what's going to happen to interest rates and understands all the variables in and out of mortgages, it's got to be you. So welcome, Kyle.
Yeah, happy to be here.
So the big question everybody asks usually at the end, and usually in those videos, they always leave the most important question to the end. We don't do that. Tell me where the rates are heading.
Okay, let me just get my crystal ball out here and let's see. I will say the crystal ball hasn't worked as well as it used to because 2022 surprised, I think, pretty much everybody. I came across a few articles a little while ago where banks are thinking, oh, rates are going to skyrocket to 4%. It's like, yeah, they went a little higher than that.
And faster.
Yeah, way faster too, right? Yeah, so it's interesting. But what I follow is I follow people that professionally bet on where the rates are heading, and as well as a number of different economists to get an idea. But generally speaking, if you look at a 12-month period of time here, most economists and others are predicting that the rates would be about 1.25 to 1.5% lower in 12 months' time on the variable rate side of things. And then they'll fall another about 0.5% over the next 2 years after that. So at the end of the cycle, they're expecting that the Bank of Canada will be at an overnight lending rate of about 2.5%, and it started at 5%, so a total cut of about 2.5% lower. And just to give people an understanding, that would mean that the prime rate would be going down to about 4.7%. Currently, it's at 6.45%. So that's the general consensus. And in the very short term, a number of different competing factors, but as of today, we have 3 more meetings between now and January. So we have one in late October and December, and then another one in January. And the consensus is 2, possibly as many as a cut at every single one of those. But between, generally speaking, the average is about 2 cuts between now and January. So about 0.5% lower in the next 3 months.
So consensus would be the banks, the forecasters, the economists, the mortgage brokers. It's of course, doesn't mean just because they're all forecasting it, they're going to be right. But yeah, 2.5%, it's lower. I've seen 2.7 and even 3% in some of the major banks, but well lower where we are today. So what would that mean to a stress test then?
Yeah, so the stress test would also be falling. So it's important to look at the stress test is based off of the rate that you're choosing plus 2%. And so, fixed rates are going to drop or projected to drop as well. But it's important to note the fixed rates are based off of the bond market, which is a forward-looking market. So they predict where rates are going. And so people expect, oh, the Bank of Canada went down 0.25%. That means my fixed rate can go down 0.25% too, right? It's like, well, not really, because the bond market is already much lower than the variable rate market. And so the projections are actually, maybe in the next 12 months, the fixed rates might drop maybe 0.5%. At the same time, the Bank of Canada drops 1.5%. So the gap between them will shrink. But the expectation, of course, is that if that happens, the stress test, if you're taking a fixed rate in the next 12 months, would drop by maybe 0.5%. Whereas if you're going variable, it'll be much easier to qualify for a variable rate in the next 12 months.
Well, and that's the big question. I get it all the time. Should I go variable? Should I not? What if the rates are going to be down? Shouldn't it be better to be a variable? What's your thought?
Yeah, I mean, the pendulum is swinging. And so if I look back to, I built a spreadsheet. Of course, many of your viewers know that I love spreadsheets, Ozzie. But I built a spreadsheet last year, and really since about September of last year, September 2023, the pendulum was either pro-variable or net neutral going fixed. But it's always been somewhere in between there based on the expectations at those times. And so, of course, the pendulum swings all the time. But right now, the pendulum is quite pro-variable, actually, unless the fixed rate is a rate that is effectively unavailable to what you can get today. But I think there's a couple keys to that. So if the fixed rates are going to drop, even if you want a fixed rate, I think a fixed rate in 6 or 12 months from now, or 24 months from now, is better than a fixed rate today. And so one of the ways and strategies you could look at is go variable, and then as fixed rates drop, you could lock it in and convert it to a fixed rate in 6 or 12 months when the rates are lower. So that's a very common strategy for our borrowers that want a fixed rate, but also want to take advantage of the short-term expectations with rates dropping. But even if you stayed variable, the projections are showing that a typical mortgage would actually be better off going variable versus fixed, given the expectations with the predictions. So obviously, who knows if the predictions are going to come to fruition? But that is, based off of the predictions, that's what's churning out in our side.
Yeah, we just had a meeting with about 100 investors, and that's the big question. What is it going to be? And what we're finding is everybody thinks because of the lower rates, buyers are rushing into the market, but buyers are actually saying, well, if I lock in now at 5% and maybe next summer at 3%, well, that 2% difference on maybe about $600,000, what's the average mortgage in Vancouver? But that makes a big difference, to me in terms of monthly payment. And then maybe I'll wait. I'll just wait that out. At the same time, the owner is saying, well, lower rates mean higher prices, and they don't want to lower their prices. So you have a different market. I think everybody expected with the rate drop that we've had already so far, the market to be hot. Well, it isn't. We've had 3 drops in the rates, and the summer has been anemic.
Yeah. I've been finding the same thing. I think like my personal book of business, I've gotten busier, but almost everybody else in our brokerage has gotten a little less busy. And part of it too is like in my 17-year career, the second half of August and the first week or two of September are almost always a very quiet period of time. People are jamming in the holidays at the very last minute, and then they put the kids back in school. So that 3 or 4 week period is a bit quiet. But I would say that generally speaking, the summer is quieter. But what I am dealing with that is not typical of a typical broker or realtor is more investors that bought pre-sales a few years ago and they have to close, and they tried to sell and they can't, and so now they're rushing to get financing. Also, a lot of deals that I'm working on are secondhand, so a bank or a broker couldn't get it done, and then I'm getting called in to fix it. So I think a large percentage of my book is not just a typical home buyer buying a home using a normal process. It's more investors that are closing on pre-sales, investors that are in a tricky bind or situation, and a lot of those also people that bought homes and then were anticipating to sell, and then the market cooled and now they couldn't, and now they're having to get private financing or bridge financing or something. So a lot of trickier deals, I would say, in the marketplace at this time.
And you have been around for a while, and you have a reputation, and I always will send you people, particularly. I know you don't want only deals that are tough, but there seems to be, people just don't understand. Not all banks are the same. And maybe not all banks are the same from month to month. Maybe they have a great 4-year rate right now because they got monstrous deposits for 4-year rates. And now they want to blow that out, and it's a slightly better rate. Or they tighten up their requirements because they're at the edge of their reserves, or whatever the reasons are. You will know that. The average person doesn't know that. And your own banker, the funny thing is that people saying, I'll go to my bank, I've been with them for 10 years. To me, that's the kiss of death, because he already has you. You're there 10 years. It's not really getting you. But a new bank, to get the new deal, I sometimes wonder, do those bankers get a commission to get a new client or a bonus of some sort? Because, boy, when you're a brand new, fresh, possible moving of your deposits over there, they're very, very friendly. But if you just, Joe Schmo has been there for a long time, maybe it's being exaggerated. But in general, lenders are more tight right now, no?
Yeah, in general, they're tighter. It's so funny on your note about how the banks will sometimes be more competitive to pull somebody away. I actually had a lender recently, about 3 weeks ago, say, here's a rate special. It's only if we're transferring a mortgage from another institution. So not a new purchase or whatever, but if we're stealing business from another bank, we're going to undercut them and offer a better rate. And so it's very interesting that you said that. And it's not, all the time that we see that, but we're seeing it right now. So very aggressive market from that perspective.
But that would mean, but doesn't that mean that maybe they're all expecting a little less business? So it's much more competitive. I mean, look, when I'm in the business of managing my properties, and they tell me that the vacancy rate is up, well, I go like heck after the tenants of the competitor, right? I offer them deals, move here, and I know we used to when we had a large number of apartments, and when we inherited the building with a lot of vacancies, we went after the competitors. Those were the only. So is that similar then in the mortgage world? It could well be.
It is for sure. And so there's actually a banker conference that happened a couple weeks ago, and a lot of the big banks, the CEOs were cited at that meeting. And so a number of them have mentioned that this is one of the most competitive markets they've been in a really long time. The margins are really thin. And so one interesting thing to note about the mortgage business is that it's often what's called a loss leader product. And so kind of like at Thanksgiving, where all of a sudden a Save On Foods or Safeway will have a crazy sale on turkey. It's not like they're actually losing money on the turkey, but it's getting you in the store, and then you're going to buy the stuffing and the gravy and the potatoes and everything else, right? So the mortgage is considered what's called an anchor product. So if they get the mortgage, it's easier to cross-sell individuals and all of the other products. And the banks don't want to lose market share. So they're making decisions right now to say, well, let's lose money on the mortgage, but then let's make sure we get bank accounts, and let's make sure we get investments and insurance and all the other things. So that's what we're seeing right now, and so they're tighter on their underwriting policies, I would say, but they're very competitive when it comes to their pricing on mortgages.
Yeah, the key word being synergy, right? I remember I used to be with a very large company called Royal LePage, and we had the sister companies was Royal Trust and London Life and all these different. And what are the synergies? How can we get life insurance and deposits and mortgages and all sort of somehow in house? And sometimes it works and sometimes it doesn't. But certainly the buyers in general, are they spooked? Are they worried? Or are they optimistic? What would you say?
A little bit of everything. I would say that the motivation is there, but immediately, just in the last month, I would say that a lot more people are thinking, yeah, you know what, I'm not in a rush, I'll just wait and see what happens. And, if the right property comes across my desk, then I'll jump. But I think the conversation of get prepared and get ready, and then watch what happens with the market, because sometimes that little spurt of, mid-August to early September, sometimes that's just a natural blip in the seasonality of the real estate market. But also it could be, just part of the bigger picture of the market slowing down, more listings coming up, et cetera. And I think a wise investor is always looking for property. And if you're predicting and notice it start to slow down, well, you're going to find that if there's less buyers and more sellers, then there are more people that will be, motivated sellers, somebody that has to sell. And sometimes you can just undercut the market. So if you think, okay, well, values are decreasing. Well, if you get a price way down here, even if the values continue to slide, you may still have value caked into it. And so, it's actually a good time for an investor to buy. I find investors like to buy at bad times in the marketplace. That's what they like to do that. And first-time buyers, they tend to kind of follow the herd. When the news tells them it's a good time to buy, they tend to buy. So interesting to see the difference in
I think you and I talked about that before. For some reason, in particular in Vancouver and Toronto, we feel that a good market means 10 buyers wrestle each other to the ground in the living room of the seller, and then one emerges victoriously, paying $100,000 more than the owner even wants, right? That's a good market, right? And today, where the mortgage broker or the realtor, where they have time to sit down with you and explain, and where you have ready to get all your documents and all, well, I'm just not sure about it, right? So, and I've always seen, I said it on Monday to the group of investors, this is your market. And the word stink bit is not a dirty word. People say, well, I can't do it. No. An owner or a developer in particular prefers a stink bit than no bit, right? I mean, make the offer. You just don't know what, if I need, let's say I need 100% of that 60% pre-sales, and I'm at 42 or 48. I need 12 more deals or whatever the number is. Well, and you walk in with an offer and you're ready and you want to sign, be surprised. I've seen people get a Tesla, $60,000 car. I've seen massive commissions to a realtor, which was surprisingly relatively low down payments. So if you check out the builder, I mean, that's the key. Is he going to close? I mean, let's face it, in the first 5 months this year, we had 20 developers a month go broke. That's 100. I mean, we had like the big one was the one was called in Toronto, 1.5 billion, big collapse. So we have that. So you want to make sure that you have a builder that's going to finish and that has the wherewithal. But then today would be the time to at least take a look. And the one thing to do is get ready for the mortgage. I mean, the bank wants to know the ages of children you haven't even born yet. I mean, they want to know everything. And in particular, if you're an investor, they want to know the leases, the names, the income.
Oh, yeah. Yeah. There's lots of, I mean, when I look back at files from 10, 15 years ago, it was incredible how thin they were compared to today, right? So yeah, they do want a lot of information and a lot of documentation, and things take longer, especially when the financing is harder and tighter. A lot more files require an exception to get approval, and what happens is because of that, the management that handle exceptions are really backed up, and it takes a lot longer to get that done. And one thing that I've really been noticing lately is a lot of people that have purchased pre-sales that are trying to offload the pre-sale and think that they're going to sell it. And then they get the notice and they say, oh, I've got to close in 3 weeks. And then they approach the mortgage broker, and then there's extensions needed and the developer charges them for it. And of course, it's always the bank's fault or the broker's fault that it's not getting done in time. But like a 2 or 3 week close is just not sufficient. You need more time than that. So I think if you do have a pre-sale, of course, try to sell it, but you should be starting the mortgage process much earlier as opposed to leaving it to the last minute, because you
Shouldn't
probably
be
will
that
have to close.
stressful. I mean, in fact, it's a real surprise to sit down with a good mortgage broker and he says, well, actually, this is what you need and this is what I need from you. That's what the bank wants. And particularly if I shop you to 3 different institutions because like your credit rating is a little marginal, or your job, whatever it is that where the broker sees maybe a potential red flag. I want to know all that. And then when you do run across something, or if you do need the money, if you don't need the money, nothing's lost, right? And get yourself some sort of a pre-approval. Now, are there any ways and means where you can overcome all the difficulties?
I mean, always, yeah. So there are net worth programs for those that have, usually the net worth starts at $250,000 in liquid assets. One of the lenders that we deal with also looks at real estate assets, which is very rare, actually. Most banks will only look at actual liquid assets like stocks, mutual funds, RSPs, that kind of stuff. So that's one way of doing it. If you're self-employed, there are a number of different programs available for self-employed borrowers. So if you're incorporated, for instance, some lenders will take the corporate income and add it to your income, or at least add a percentage of it. So that helps.
Yeah.
And then, yeah, I want to talk about something creative that I did for one client, and then I realized that I could do it for another client, and now I'm keeping my eyes open for it because this is becoming a more popular thing. But the shift has been in the last year or so, I've noticed a big shift from I want to save in interest to I want to save in payments. There's a really big concern, and people are putting the payments more important than the interest cost. And we usually see the opposite. People are usually focusing on what's going to cost me the least amount of interest. But because of that shift and because of the financing getting tighter, as an example, I had a client that came up for renewal, and we're trying to finance two properties. So they have a residence and a rental property, and they both had short amortizations, high payments. And I couldn't actually really qualify either of them to refinance, redo them, get lower interest rates, stretch the amortization out, lower the payments, and give them some payment relief. But one of the things I looked at, I just asked the question, like, how are you with the payments? And like, well, it's a little bit tight, they're a little bit high. And then I suggested, well, you could qualify for a reverse mortgage. And so we put a reverse mortgage on the home. So now there's no payments. And then we had an opportunity, then we could qualify them to refinance the rental. And then we stretched the amortization out, got a lower interest rate. And now we have, substantially improved the monthly cash flow. And then I realized that I had another customer that was going through a similar situation that was even much larger. And we did a very large reverse mortgage on the residence and then refinanced another property to bring all the numbers in line. And that borrower was saving $10,000 a month in payments. And so it's really interesting how I think that this is a unique strategy, in particular because the only other opportunity for that second client I had was a B lender, and they're going to pay higher rates and fees and everything, which was kind of equivalent to what you'd pay on the reverse mortgage, except there's no payments. So it was a very interesting product, and I have experienced myself that the reverse mortgage is becoming a much more asked about product lately.
Well, and we should watch, if you're interested in a reverse mortgage, watch the video that you and I did, I guess 3 or 4 months ago.
Yep.
The point that you actually made that, if you want to help your children and, the children want the cash and they can't make the payments, and you don't really want to take a mortgage out because you don't want to have the payments, a reverse mortgage may be the thing to go. If I had a $500,000 reverse mortgage on my home and I don't make payments and I have 2 children, give each $250,000, well, that's a down payment on which they don't have to make a payment.
Yeah.
And then they're going to get the house anyways when I die, right? So whatever extra costs are from that mortgage when nobody has made any payments is really meaningless, down the road, right?
Yeah.
The other thing I found too, it's true, the lower payment is more important. That's why the government is realizing and going from 25 years to 30 years. That, if you want to sit down with your pencil, well, that costs you another 60,000 in interest. At this point in time, it is not important because we don't have anyways a 30-year mortgage. We have a term. So it's what you pay during the three years. And if I pay 2,000 a month versus 3,000 a month, well, that's a cash out of pocket. What I then owe after that time is less relevant. The thing is that always in the end, you're not never going to beat the banks, but
Yeah, I know, exactly.
You can afford it and your life is better because I tell you, people have been stretched to the limit with summer when they came in at the wrong time or went from 1.9% to 6.6% or some crazy jump, and all of a sudden they have these payments that they never bargained for.
Yeah.
Now, there's one thing that's out there that's not generally being talked about much, but first of all, the Office of Financial Institutions, or is it OFSI? Is it
OSFI? Yeah.
OSFI,
So the superintendent. You forgot the superintendent part.
Superintendent, that's what it was, right?
Yeah.
Well, that superintendent came up with this super idea, which was kind of concerning. First of all, they raised the requirements of the banks in reserves from 3% to 3.5%. Now, for the average person says, what's 0.5%? Well, to me, and correct me if I'm wrong, that means that the bank actually has less money to lend out, right? Because they have to have more as a reserve. So what is that? What did the bank anticipate in May this year, right, in order to come? And then secondly, they came up, which I think is, and I think you made that point in another video, that you're limited to 4.5% of your income in terms of what your mortgage could be like. So if I'm a $100,000 earner, I can only get a $450,000 mortgage. Now, that didn't matter much when the rates stayed the same. But normally when rates go down, let's say by 2%, I might get more money and could get from 450 to say 550 or 5. But that looks like not possible anymore.
Yeah, so first I'll talk about the first point, which is the capital reserves. And so really what the impact of the capital reserves mean is that in order for the bank to lend out money, they have to have a little bit more sitting in the bank, earning them no interest. And that just means that their margins are now thinner on lending out money because they have to stockpile more cash. So interestingly, what we're finding on the mortgage side is that a lot of the banks are incentivizing borrowers to say, hey, I'll give you cash back if you have your mortgage payments come out of our bank account. And they're really trying to incentivize and get access to people's GIC money and investments and doing a lot of things to do that. And we're seeing some banks incentivizing that in a number of different ways. And so that's really what they're trying to make sure that they get as many assets as possible. And some banks, in order to bring those ratios in line, like Scotiabank about a year and a half ago, was way out on their capital requirements, and they became completely uncompetitive in the mortgage game for about a year or a year and a half, just to lower the amount of mortgage debt. And they're trying to inch up the amount of assets they needed just to make sure that they were in line with the capital reserves. So pretty interesting on that front.
To me, it actually meant they might be more competitive on what they offer on the GIC because they wanted to attract more capital into their for those requirements. I mean, right now, the banks in the United States this week, this is the week of September the 11th or 12th, where Jamie Dimon came out and made some fairly dire predictions for next year on all banks in the United States. And then in a 2-hour period, the stock, I mean, we're talking about the largest, banks in the world, went down 7%. I mean, and then finished only 5%. But I mean, my God, what are we talking about? Billions and billions and billions. And then we have more, of course, our Mr. Buffett, who believes in long-term investment in the stock market. Don't go in and out of the stock market. Always buy the stock and stick with it. Well, he sits on $270 billion worth of cash, really. And then Mr. Burry, who predicted the collapse of the problem with the 2008 general market collapse. He sold half of his holdings into cash. So what do these guys experience and anticipate? So no doubt about it, the senior executives of any bank in Canada or any bank around the world, they have their concerns also. It is a crazy world out there.
Yeah.
So I think that maybe the idea of limiting the amount that people can buy that the bank put into place in May Well, they were anticipating rates to be a lot lower.
Yeah, yeah, and it's interesting. So it won't come into a play, and it won't be a major factor in the sense that it's not on a per borrower basis. So that new 450% requirement means that they're not going to look at each borrower and say you don't, you do qualify. But what they do look at is the back end on a portfolio basis. So your $100 billion in mortgages with that bank, they're going to say, are you in line or out of line? So it's more of a slow moving ship type of thing. But as rates come down, Oz, you made a great point. The amount of money that you can borrow as a function of your income increases because if the stress test rate goes down, you can borrow more. So before in 2021, you could borrow about 5 times your income, and now it's only about 4.5 times your income. Well, as rates go down, you can get back down, back to borrowing 4.75 or 5 times your income again. So I think we're going to see that shift, and then the banks might eventually, if rates stay low, they might get to a point where they get quite bloated and they get too close to that ratio, and then they'll have to tighten up. So that probably will come down the pipe in years from now, in my opinion. It probably would be at the earliest, like 2026, we actually see lenders tighten up because of that policy, just because so many of their mortgages have now been booked at 400% or 350% ratios as opposed to 500%.
Well, I don't profess to understand it, because if I have 100 billion, do I have to know what all the income is of all these owners of that mortgage, right? And then have to compare that. I also thought that if I right now have a 450,000 mortgage on my $100,000 income, that's all I can borrow. But if rates come down, normally I would be borrowing more, but it looks to me now I'm still tied to that 450,000. And if that's it, I can actually not increase the mortgage. Am I not correct in that?
So no, there was some confusion when it first came out that we thought it might be per borrower, but it's going to be on a portfolio basis. Yeah.
So it doesn't affect HELOCs and so on, because that's one of the questions I had, that will they take my HELOC that I owe together, and is that all part of that 4.5 times? So you say that's not the issue.
Yeah, they won't be adjusting it on a borrower basis. But what happens is if a bank starts to near that ratio, they're going to have to tighten up debt servicing and tighten up their qualifications so that then the number doesn't quite reach that figure.
Yeah, well, that's good. You should talk about it more. Like it was on, like when you have a whole bunch of investors, everybody's worried about everything, right?
I know.
We had a lawyer talk about the duties and the opportunities for landlords, and we had a free-for-all. I mean, it's tough out there, with the new legislation. Realtors are saying they don't want to list any property that has a tenant in it, because it's 3 months notice plus a month to dispute. So you have a sale right now that's closing in February. I mean, most people that have a sale now, they want to close within the next month. So problems galore, but particularly on the financing side, you can have a deal as a realtor, you can have everything, but if you don't get the financing in place, and that's why in this world, you really need an expert. And so I salute you what you're doing. You also have a new venture that you're going into, more to do with the infamous or famous 2 letters, AI.
Yeah. So technically our current product doesn't use AI, but the way that, or on our roadmap, we will be integrating more AI into the product soon. But it's effectively a tool that, as a mortgage broker, I'm using as a tool that will be selling to other mortgage brokers. And basically, it's just a tool that allows a borrower to have their information entered in just once, and it underwrites for all of the lenders for all the products simultaneously. So it speeds up the process of being able to observe what a client qualifies for very quickly. So as of now, my own team and whatnot, because we're developing it, we do have a prototype and it is working. And so I can go to a customer and say, hey, I just need to fill in this sheet with information. I don't need documents. I don't need credit check or anything, but fill in this as accurately as possible. And I can then take it and then underwrite all the lenders, all the options simultaneously without doing that. So usually it helps with investors in particular that have 5 rental properties. Do you really want to send 200 pages of documents just to find out that you are not even close to qualifying? No. I don't want to do it. You don't want to do it. So we say, fill this in, send it back. And then we say, yeah, you know what? I think you're in the ballpark. Now let's jump in and do the document. So that's where I found it quite useful. That's the value for a borrower. But our product, as we turn it into software, is really going to be used for brokers to do the same thing so that brokers can do that. And
really a big deal for a broker. I mean, it saves a lot of time. No?
It's incredible. We already have some, use cases where brokers are saying, oh my gosh, Kyle, this took 5 minutes. It would have taken me an entire day to call the lenders, look up this, look up that, and call to see if they'll make that exception. And yeah, it's very, very complex, but it's an insane amount of data. We have to map out so many data points to connect everything together, and that's where the challenge lies. But we're up for the challenge, and we think we're going to fundamentally change how mortgage brokers are able to underwrite and approve their clients and get them the best rate that's available.
Yeah, it's interesting. We always use AI this, but you have somebody has to do the input for AI to work out the solution and solutions. So I'm sure it's not easy, but that would be certainly, if I was a mortgage broker, that's what that'd be worth my while to pay for whatever the costs would be to get the program running. Yeah. What about the rest of the mortgage market in the future that you see? What do you feel? What are we positive, negative? What do you think?
Yeah, I guess a couple of factors, a couple of things that I'll just mention, and then there's an opportunity that I wanted to share with your audience too today, Ozzie, because this may be something that everybody wants to hear about. But generally speaking, as we enter into a market where the prime rate is starting to decrease, the reasons that the prime rate will decrease are generally the same reasons that the cost of funds to fund mortgages increases. And what that means is that, yes, usually the bond market is decreasing. So even if the cost of funds increases over top of those bonds, usually rates are still going down. But one area where this doesn't quite happen is the Bank of Canada and going variable. So as an example, in the subprime crisis of 2008, variable rates went from prime -1 to prime plus 0.8%. In COVID, they went from prime minus 0.7 or so to prime plus 0. And so, these are situations where those are obviously a lot more aggressive than I think what we're going to see in the near future. But we have already seen a couple of lenders decrease the discount off of prime. And so as the cost of funds increases, the banks say, well, our margins are getting thinner because it's harder to find buyers for mortgages if people are worried about those same buyers not having a job in 6 months or, not being able to afford it. So there are some concerns about that. So just a note that if you wanted to get a variable rate mortgage, you may want to get that a little bit sooner rather than later. If you're getting into a fixed rate, well, fixed rates are probably going to be dropping. So if you come out for renewal in 3 or 4 months, if you want a variable rate, you actually should be getting a pricing locked in now. You want to go the fixed rate anyways, probably just wait until the very end to convert and get the fixed rate done for your renewal.
Yeah, particularly if you're right and the rates keep on going down.
Exactly.
And then you're saying, do all the banks sell all their mortgage products to some other investment institution, like a mortgage-backed security?
Yeah, they all do that to a certain extent. Of course, they do have different funding sources, right? So some things keep some of them on their own books. A lot of them they bundle up and sell. It really depends on the situation.
I thought we would never hear the word mortgage security again.
Yeah, it doesn't come up a lot, It's kind of a behind the scenes thing that the banks do, Ozzie. So, the reason for that is that if they can sell the mortgages and get them off their books, they don't have to have the same capital reserve. So that's one reason that they do it. And secondly, they get more capital in to just keep churning it, and they just take a spread off of what they lent out the money at versus what they're paying somebody else at, and they're just taking a spread off of the middle. So, it's very common for them to do it. And this is actually why, a lot of people, it doesn't make sense to them, but if you put 5% down, you'll get a better mortgage rate than if you put 50% down. And the reason for that is that the mortgage is insured if you put 5% down. Insured means it's backed by the Canadian government. So it's actually the best asset to sell because it's not only backed by the Canadian government, so there's effectively no risk. Also, the borrower paid for the insurance premium. And so it's actually where the best margins are for the banks. And so a lot of the time, the parents are gifting money to their kids and their mortgage rate's higher than the kids. It's like, what? They just graduated and they're getting a better rate than me. And it's just because the mortgage is insured, which makes it easier for the lenders and the banks to sell it. Like, you'd be more comfortable, Ozzie, if I sold you an investment and said, by the way, the government's going to guarantee that you're okay on this debt. You're going to say, well, that's lower risk. And so I'm okay getting a lower yield on that, right?
Well, that is so interesting because a normal person stands in front of this big bank and it's all huge stones and blocks and very impressive. And you think that bank has all this money that it lends out, but it's a business. And in that fine building, there are all of these nooks and crannies. You got to get rid of a whole bunch of books. And this is what happened, of course, in 2008, that some of those mortgage-backed securities weren't really secured by anything. They were secured by people that had no work and used unemployment checks as their source of income. But this is a different world, but it's still a business. And when I look at, my God, the TD Bank got zapped, the Scotia got zapped in the United States by multi-million dollars. And there was some banker in the organization doing business, but it happened to be, making the wrong kind of business. So generally, are you optimistic that we're turning the corner, or is it still a very
optimistic? That being said, I'm not sure what the market will hold for the next 3 to 6 months, and so I do think that there may be blood in the streets for 3 or 6 months. But I think by next spring, if rates are 0.75 or 1% lower on the variable side, and maybe 0.25% higher or lower, or maybe even 0.5% lower for fixed by next spring, I think that will be enough to offset what negative influences we might be seeing in the market. Interestingly, CMHC put out a report not too long ago, and they were predicting that the valuations by the end of 2026 will be about 14% higher than they are today, which actually really shocked me, because usually CMHC is fairly conservative, but they're looking at a couple of factors, which is a lack of new inventory that is getting started today. And a lot of developers are kind of delaying those starts. And so I'm sure that you see that a lot, where the margins are too thin, there's risk, not a lot of demand for pre-sales. And so there's just not a lot of new construction being started, combined with lower interest rates and a lot of immigration that's happened in the last couple of years. Those people settle in, get used to it, get jobs, and then eventually they like to buy. So I think those two things, increasing demand, and then that one thing, decreasing the available amount of supply we need, that's a bit of a perfect storm for where values will be in a couple of years.
Yeah, and that's, certainly my philosophy that eventually everything settles in with higher inflation. We owe the world $300 trillion. We'll never pay it back. The only way we can pay it back is through higher inflation and through outright inflation of all assets. It's funny when we always talk about, inflation is down. Well, yesterday the US reported inflation was down, but then when they took out gasoline and a couple of other things, all of a sudden it's actually up, and everybody goes shopping. I have in my Ozbuzz newsletter, I have the Camembert index, and I look at the Camembert that was $8 at 300 grams. It's now $12 at only 200 grams, because they got me both ways, one on the price and then there's less Camembert, right? And any housewife that goes shopping right now realizes that the inflation is not 2%. Look, thank you very much. You certainly are an eye-opener in the mortgage business, and anybody that has the need for a mortgage, you're the man, and your team. I know that you're very good at also private money, that sometimes it simply cannot be done in financial institutions, or you have multiple properties that were easy to get the financing for, and now it isn't. Anybody that wants to have an investment kind of environment should go to the Green Mortgage team. Thank you very much, Kyle.
One thing I want to add really quickly, Ozzie, is because we've identified a quick opportunity in the market. If you have a mortgage, especially if you took a mortgage in the second half of 2023, most of those fixed rate mortgages are 5.5% or above. There's an opportunity right now where the penalty to break those mortgages is not very expensive. It's probably 3 months interest, but the savings of redoing the mortgage and dropping the rate is quite expansive. And so if you have a rate that's over 5.5% or higher, especially if you have about 2 years left still or longer on your mortgage, then you may be able to save a significant amount of interest. So reach out and we can do the analysis and give you some feedback.
But it's those kind of secrets and little tricks of the trade. This is what you need to do and look for. And as an individual, you have to save yourself, because that makes sense, because prepayment penalties normally can kill you, because they are really, really unfortunate. Thanks a lot. All the very best, Kyle. And we will have his contact information below. And those of you that are listening on our podcasts, simply send me an email at oz@jurock.com, and I'll send you Kyle's phone number, or maybe better, just the email address.
Yeah, doesn't matter. Phone and email is great. Yeah, awesome.
You're a busy guy.
Yeah.
Okay.
All right. Thanks.
Bye-bye.